Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 124. And in this episode, we are reviewing the performance of the global markets during the 36th week of 2024. And that is from Monday the 2nd to Friday the 6th of September. And without further ado, this is your host, Jamuhuri. And together, let's dive right in. We kick it off in the United States, where the economy created slightly fewer jobs than expected in the month of August, reflecting a slowing labor market, whilst also clearing the way for the Federal Reserve to lower interest rates later this month. According to the Labor Department's Bureau of Labor Statistics, non-farm payrolls expanded by 142,000 during the month, up from 89,000 in July, but below the consensus forecast for 161,000 new jobs. At the same time, the unemployment rate ticked down to 4.2%, in line with market expectations. However, the labor force participation rate held steady at 62.7%. And staying in the United States, the U.S. Treasury Secretary Janet Yellen sought to reassure the markets that the U.S. economy remains strong despite a string of weak job reports that have rattled investors and weighed on the stock market. Yellen said job growth has slowed compared to the hiring frenzy when the U.S. economy reopened after the COVID-19 pandemic, but that the economy is deep into recovery and basically operating at full employment. And in related news, Nobel Prize-winning economist Joseph Stiglitz says that the Federal Reserve should deliver a 50 basis point rate cut at its forthcoming policy meeting, accusing the U.S. Central Bank of going too far too fast with monetary tightening and worsening the inflation problem in the process. In the U.S. stock market, mega-cap tech stocks tumbled as investors dumped risk assets amid mounting worries about the health of the U.S. economy. Fresh August jobs data added fuel to concerns of a slowing labor market as a bout of weak data has packed worries about the health of the U.S. economy, spooking markets and denting risk appetite in recent weeks. The S&P 500 dropped on Friday, notching its worst week since March 2023 as investors assessed the fallout from the weak August jobs report and ditched leading technology stocks. The broad market index slid by 1.73% to settle at 5,408, whilst the Nasdaq Composite shed 2.55% to close at 16,690 as the tech-heavy index ended the session more than 10% off its record close, and meanwhile the Dow Jones Industrial Average fell 410 points or 1% to end at 40,345. In the U.S. bond market, U.S. Treasury yields fell on Friday after non-farm payrolls for August showed an easing labor market, fueling concerns of an economic slowdown in the United States. The employment data comes ahead of the Federal Reserve's policy meeting, which is set to conclude with an interest rate decision on Wednesday, the 18th of September. And according to the CME Group's FedWatch tool, markets are expecting the Fed to reduce its policy rate and are currently pricing in a 57% chance for a 25 basis point rate cut and a 43% probability for a deeper rate cut of 50 basis points. In response to the foregoing, the yield on the benchmark 10-year Treasury bond was 1 basis point lower at 3.72%, whilst the yield on the policy-sensitive 2-year Treasury note dropped by 9 basis points to trade at 3.66%. For your information, bond yields and prices move in opposite directions, and 100 basis points is equivalent to 1 percentage point. In the commodity markets, the price of crude oil hit the lowest levels since June 2023, putting the U.S. benchmark on pace for its worst week over the past 1 year, as OPEC Plus has failed to reassure the markets about a balance between global supply and demand. The price of crude oil dropped sharply on Friday as OPEC Plus delayed plans to increase production by 180,000 barrels per day until December. The output hike will bring about 2.2 million barrels per day back into the market through to the end of next year. And in response, the price of the U.S. benchmark West Texas Intermediate crude hit a low of $67.17 earlier in the session and shed 8% for its worst week since October as it came to a close at $67.67 per barrel. Meanwhile, the price of the global benchmark Brent crude fell about 9.8% this past week and eventually settled at $71.06 per barrel. In the precious metals market, the price of gold fell on Friday, retreating from near record levels reached earlier in the session after U.S. jobs report cast doubt on the size of the rate cut expected from the Federal Reserve at its next policy meeting. Investors are now completely unsure whether the Fed will opt for either a 25 basis point rate cut or a deeper rate cut of 50 basis points to shore up the U.S. economy. For your information, lower interest rates reduce the opportunity cost of holding gold, which is a non-yielding asset compared to bonds and equities, which provide yield in the form of coupons and dividends. And in response to this outlook, the price of spot gold fell 0.8% for the day to close the week at $2,495 per ounce. In the cryptocurrency market, a basket of crypto-related equities fell to its lowest level since February as cryptocurrency exchange Coinbase wrapped up its worst week of this year. The industry-wide sell-off reflected a growing concern about the health of the U.S. economy and tracked a broader decline in prices of major cryptocurrencies such as Bitcoin and Ether. According to CoinGlass, September is historically a difficult month for crypto assets, with Bitcoin notching an average loss of 4.8%. Meanwhile, the Crypto Fear and Greed Index, a gauge of crypto market sentiment, is firmly in the extreme fear zone, indicating that investors are worried about market risk. In response, Bitcoin slipped to its lowest level since February, falling 4% in the past 24 hours to settle at just around $54,000 per coin. And on that note, we now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling remained relatively stable versus the US dollar. And according to data obtained from the Central Bank of Kenya website, the official exchange rate for the US dollar was quoted at 129.19 compared to 129.04 the previous week. However, in the interbank market, commercial banks were selling the US dollar within a narrow range of between 131 to 132 shillings. The lowest rate was offered by Stanbic Bank at 131.45, and the highest rate was quoted by I&M Bank at 132.05. Meanwhile, the sterling pound was priced at 169.90, and the euro was valued at 143.13. And on the regional front, one Kenya shilling was changing hands for 28.80 Ugandan shillings and 21.05 Tanzanian shillings. And to the Rwandese franc, it was posted at 10.30. On foreign exchange reserves, Kenya's usable foreign exchange reserves surprisingly increased by $154 million to $7.5 billion, which is equivalent to 3.9 months of import cover. This level of reserves still falls below the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing national debt that has pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market remained sufficiently well funded and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this declined by 21 basis points to 12.59%, down from 12.80% that was recorded the previous week. And in terms of volume, the average value that was traded in the interbank market increased to 25.5 billion shillings, and this was up from 15.2 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 16.4 billion shillings. For your information, the cash reserve is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 5th of September, and the central bank received bids totaling 38.9 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 162%. The central bank ended up accepting 36.9 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by about 2 basis points to average out at 15.76%, whilst the 182-day rate slid by less than 1 basis point to close out at 16.62%, and the 364-day rate was a tad bit lower by 2 basis points to finally settle at 16.82%. In the primary bond market, the Central Bank of Kenya, acting in its capacity as fiscal agent to the Republic of Kenya, is inviting bids for its September bond issue, in which it is looking to raise a total of 30 billion shillings for the stated purpose of budgetary support, and the terms and conditions of the bonds on offer are as follows. The first bond is a 10-year bond, reference number FXD1/2024/010, with 9.5 years left to maturity and a coupon rate at 16% flat. The second bond is a 20-year bond, reference number FXD1/2016/020, with 12 years left to maturity and a coupon rate at 14% flat. These bonds are now open for sale until Wednesday, the 18th of September. In the international markets, during the week, the yields on Kenya's Eurobonds were on an upward trajectory, with the yield on the 7-year 2019 Eurobond increasing the most by about 20 basis points, as it rose from 9.9% recorded the previous week to 10.10%. At the Nairobi Securities Exchange, during the week, the equities market was on an upward trajectory, with the NASI gaining the most by 1.8%, whilst the NSE 20, the NSE 25, and the NSE 10 all gained by the same margin of 1.7%. This takes the year-to-date performance to gains of 21.4% for the NSE 10, 19.9% for the NSE 25, 14.8% for the NASI, and 13.2% for the NSE 20. The market's performance was driven by gains recorded by large-cap stocks such as KCB Group, Equity Group, and Standard Chartered Bank, which increased by 6.1%, 5.1%, and 3.8% respectively. This performance was, however, weighed down by losses recorded by other large-cap stocks such as Cooperative Bank, British American Tobacco, and Absa Bank, which declined by 3.3%, 2.4%, and 1.7% respectively. Up next is our topical issue, and this week we're looking at accusations of reckless lending to Kenya by the World Bank and the IMF. The World Bank and the International Monetary Fund have been confronted with damning accusations of reckless lending to Kenya, as their rebuttals are disputed by audits and budget reports. The Bretton Woods institutions have addressed concerns about the cost and legitimacy of loans to Kenya at a time when the country is battling a debt burden in excess of 10 trillion shillings, and amid reports of hundreds of billions in borrowed funds that cannot be traced to any project. Busia Senator Okiya Omtata and Safina Party leader Jimmy Wanjigi have publicly stated that Kenya has overpaid its debt obligations by over 1 trillion shillings, and this information is based on the government's own revenue books. Additionally, both personalities have claimed that Kenya should not repay what they described as odious debt that was never spent on development in accordance with the law. The Auditor General and the Controller of Budget have both questioned the true cost of concessional loans, with rising calls for a transparent forensic audit of the country's national debt. Kenya owes the World Bank about 1.5 trillion shillings, and currently there are 36 ongoing projects that are funded by the lender, which are valued at more than 950 billion shillings. The World Bank said that the state's due diligence determines the viability of proposed projects before cabinet approval. And prior to approving the loans, the World Bank undertakes a comprehensive appraisal to assess the project's feasibility and the capability of the entity chosen to implement the project. And thereafter, in collaboration with the government of Kenya, both parties engage in a dual due diligence process that spans the entire project life cycle from inception to completion. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, no one is coming to save you, because no one can save you from yourself. Think about it. Thank you, and God bless.